All right, so I guess we should start talking about running and start talking about tax. Yes. Hello, everybody who's joining us for our webinar with Nicci from TaxTim. We're here to talk about something that I think affects a lot of South Africans, and I think a lot of South Africans probably wish they knew more about. So we are going to be talking about a lot of tax questions, a lot of different topics. I'm just going to run through them briefly before I ask you for an intro. Okay. Are you nervous?
I love being on camera, don't we all? Not at all.
Cool. Don't be nervous. We're going to help some South Africans today, I think, hopefully. So, yeah, put that in your back pocket. What are we going to be talking about? We're going to talk about retirement, savings, and tax. This is a question that came through quite heavily in the forms you guys submitted. We're going to be talking about a tax-free savings account, which isn't actually a savings account at all. It's an investment product, and you can go 100% offshore with that. So a bit of a weird naming convention there. We're going to start talking about saving tax via donations, as well as working from home, home office tax deductions. We're going to talk about medical expenses, so the medical aid contributions that you guys make. We're going to be talking about getting tax back on those. Traveling for work, the work itself, so side hustles and freelancing, something that also featured quite heavily in what you guys submitted to us. We're going to talk about the difference between provisional tax paying and PAYE. And then some investment income and tax questions, and included in that, crypto and tax. And then there's just a general Q&A. Some of the questions you guys submitted, we're going to put those to Nicci. And hopefully we can help you guys understand a little bit more about the lay of the tax land in South Africa. So, sorry, that was a huge monologue. Welcome to our webinar. Would you like to just give everyone who's watching a little intro to you and to TaxTim?
Yes, thank you. So, yes, I'm the CEO of TaxTim. We offer an online digital tax return completion service. So we help thousands of taxpayers complete their tax return online via a very simple, automated, sort of a chat type system where think of TaxTim as your digital tax practitioner. Friendly little man pops up on the screen and asks you questions, very easy, no tax jargon, simple, plain language, asks you questions about your income and expenses and guides you through all the typical deductions that you could potentially claim and uncovers all those, home office, medical, to really try and help you maximize your tax refund and reduce your potential tax liability. And then our system populates the tax return in the background, and we are integrated with e-filing. So with one click, you can just submit your tax return straight to SARS. So you don't really need to go on to e-filing. Yes, and go on to e-filing and deal with all the complicated, source codes and difficult e-filing forms. Yeah.
Wonderful. Fair to say you know tax. You've been involved in tax personally pretty much, I would imagine, your whole working life.
Yes, so. Mostly. Yes.
Cool. So let's kick right off. We were going to talk about retirement savings, so investing for retirement, yes. And tax, and how sort of tax rebates work on that, and anything else you think is good for people to hear.
Okay, sure. So contributing to a retirement fund, right? So you can contribute up to 27.5% of your taxable income to a retirement fund. So when we're talking about retirement funds, we're talking about pension, provident, and of course retirement annuity funds. Yeah. So that's quite a large amount, up to 27.5% of your taxable income, and that is capped at 350,000 Rand a year. But if you do contribute over that amount, then those deductions are carried forward into the next year and set off against your next year's limit. A retirement fund is a very effective tax-saving investment because there's no tax on the growth of the investment, so there's no tax on the interest, dividends, capital gains as you're contributing. When you do retire, you can take up to 1/3 of your retirement fund as in the form of a lump sum, and then there's special retirement tables that apply, and the first 550,000 Rand is actually exempt from taxes. It's one-off exemption. And then the other 2/3 is your pension. You take the pension during the rest of your retired life. So it's pretty good. It's very effective as a form of a tax saving type investment. Because also when you are retired, you generally will be earning less income than during your working life, and therefore your tax rates on your pension will be lower than while you're working. So yeah, now we're heading into February. It's almost the end of tax year, the 2025 tax year. So if you do have any, if taxpayers do have any excess cash or bonus, now would be a good time to put it into an RA and reduce the tax for 2025. And just, of course, make sure that when you come to do your tax return, make sure that you include those retirement fund details in your tax return, and get that tax certificate from the financial institution, and you need to include those details in the tax return in order to get the tax deduction and save on tax.
How does the rebate from SARS actually work? So I contribute X amount. What do I get back? So let's say to an RA.
Yes, so if you contribute into an RA, it's a straight deduction of your taxable income. So you're reducing your taxable income by the amount of the RA. So it's the contribution times by your marginal tax rate. So if you're in the 41% tax bracket and you're contributing 10,000 to an RA, it'll be 41% times 10,000.
Right.
Is the amount that you get back.
Okay.
Pension and Provident, it works a little bit differently. Pension and Provident is the deduction by your employer, and that will be on your salary slip every month. And
you see the tax benefit straight away.
Exactly, you see the tax benefit straight away, whereas the RA is more in your own personal capacity, and that you will get a reduction when you submit your tax return.
Cool. Yeah. Okay. We'll move swiftly along. I know there'll probably be some viewer questions that come through on sort of more the vagaries of that whole setup as we move on. But let's get to the second topic. I'm quite conscious of time. We have there's a lot to talk about. No, that's great. Can you give us more information about a TFSA, so a tax-free savings account? And just and we have had questions about how saving into this, how investing into a TFSA differs, say, from an RA. So maybe a little bit just around the TFSA itself, and then maybe that question, sort of the difference between that and a retirement type.
Okay. Yeah. So tax-free savings account is basically, most banks offer it.
And investment companies.
Yes, and investment companies like 10X.
Yeah.
You can invest up to 36,000. It's important to know the limit. You can invest up to 36,000 Rand a year. And there's a lifetime limit of 500,000, so that's like an investment horizon of around 14 years.
If you max it.
If you max it, yes. And your investment will grow. It's a tax-free in there, tax-free. There's no tax on the interest, dividends, capital gains. And yeah, you mustn't exceed that 36,000 Rand a year. Very importantly, SARS will slap on a 40% penalty.
A 40% anything that you've exceeded.
Anything exceeded, yes. And we've seen that quite a lot. It does happen because sometimes, you can open up tax-free savings accounts with a few banks. It doesn't only have to be one. And you might lose track, so you could put 20 in one and 16 in another and 10 in another. If you exceed that limit, you will get, if you exceed it by 10,000 Rand, you'll get a 4,000 Rand penalty.
I guess also worth mentioning is that if you pull out of that TFSA, you're pulling out that whatever you've withdrawn counts towards that limit as well.
Yes.
Right? So you can't put it back. Yes. If you hit the 500 or the 36 and you pull out, you can't then put, rebate.
Exactly, yes. Also worth mentioning is that you can open tax-free savings accounts for your children, and they have their own limits for your minor children. So that's quite useful.
Yeah, so I guess the similarities between that and an RA would be that you're not paying tax on anything you earn in those investments, right?
Yes,
so you're getting the compound interest, you're getting all of that added to your investment over time. And you're not, and SARS isn't coming at you and saying, well, you've made X amount of profit or whatever on your investment.
Exactly, yes.
You need to pay us.
Yes, but of course you're not getting a deduction. So the RA, you're getting a tax deduction. You're getting a reduction in your taxable income. You're saving tax of your tax bill. It's a bit different to the tax savings account. Yes.
100% differences.
Yes.
The other thing being with the TFSA is that it's really, you say an investment horizon around 14 years, but what we're actually talking about is to get the greatest value from that product, you actually need to invest for a much longer time to let that compound interest grow for you. So if you get to that limit and then say, right, in 20 years, I've had, my 500,000 or whatever that's compounding. If you're pulling that out of that investment all the time, you're getting the tax benefits in the short term, and you're not getting taxed on those withdrawals, but you're not letting the product work.
The product work, exactly. Yes. But now also timing of year is important. Similar to the RA, you may as well if you have excess cash, you could put money in now, end of Feb, your 36,000. That limit runs for a tax year, so it's a large chance.
Well.
Yes, it's a large chance to save again, to max out that 36,000 if you have excess cash. So I don't know, around sometime in Feb.
Okay, fantastic. Let's move on to other ways to save about tax. We were talking specifically about donations. I think this is something that South Africans don't know at all.
Really?
Yeah, so I didn't when we were discussing what we were going to talk about. So, I mean, you hear about it, but you don't actually know the mechanics. So maybe we can talk a little bit about donations to NGOs, NPOs, PBOs, and the real public benefit organizations. Yeah, how does that work?
Yes, so if you donate to certain charities, not all charities, there you can get a tax deduction. So a tax deduction as in a reduction of you reduce your taxable income and you're paying less tax to SARS. Certain charities, they have to be registered with SARS as public benefit organizations. We call them PBOs. So these are exempt organizations. They don't pay tax themselves. They rely on donor funding, like the SPCA, Meals on Wheels, charities that are set up, for welfare specific reasons. So you just need to make sure that if you contribute, you get your Section 18A tax certificates. Make sure that they are a registered PBO. They should have a PBO number because you need to report that in your tax return. SARS will want the PBO number, and they will also definitely request the Section 18A tax certificate that the institution must issue you. So it's a good way to save a bit of tax and also, donate to a charity close to your heart. There's a limit there as well. You can only contribute up to 10% of your taxable income. If you exceed that limit, then it's not lost. It gets carried forward into the next tax year and set off again against the same, against that limit. And good to know also some place you might be donating and you don't even realize it's a PBO. For example, some neighborhood watches are set up as PBOs. So if you're contributing to neighborhood watch, it's worth finding out if it's a PBO. Because they don't often send you, I know where I live, they don't send a tax certificate automatically. I just find out, it's a registered PBO, and then I requested a tax certificate, put it into my tax return, and it's
free money.
Yeah, exactly.
Yeah, okay, wonderful. So we've moved sort of very quickly to a topic that we've got a lot of questions about, and that is work from home questions, home office questions. There's obviously this is impacting a lot more people since COVID, and I think people are confused with deduction work, and specifically, I would imagine it's hard to be exhaustive on this, but what costs are claimable?
Okay. Yeah. This is a big topic. And quite a lot has changed since 2021. Everyone was claiming home office, and also everyone was working from home in 2020 and 2021. And SARS has put out some guidelines and also got a bit stricter because literally everybody was claiming home office. Very unexpectedly, it all just suddenly happened with the COVID pandemic. So there are some quite strict requirements. So first of all, you have to work from home more than 50% of your time. Has to be working at home.
How do you prove that?
You need to get a letter from your employer, and your employer has to basically state the percentage that you're working from home. So
and
it's
if you
confirmation.
work for yourself? If you are your own employer?
Well, then the rules are different. So for a salaried employee, it's different to being a sole proprietor.
Right.
So if you're freelance, it's actually easier to claim home office deductions. The rules are quite different. Salaried employees, very much stricter deductions. The rules are different, and you need to get a letter from your employer stating you work from home, the amount of time you work from home, whether you have an office or not. If you can come into your office, the employer and on a company letterhead. That's the way you basically prove it, I guess. Okay, so 50% of time from home, but then another big one is you have to have a separate room in your house, which is specifically and exclusively used for your work purposes, but it can't be, and then there's this exclusive requirement, it must be exclusively used as a home office. So people were working from their dining room table, from their lounge, that's not considered a home office. SARS used to be a bit more lenient. You can't actually work from a space either. People were working from a one-bedroom flat and maybe had a little corner of their bedroom set up as a home office. SARS have actually come down quite strictly and said, look, you need a separate room, which is specifically and exclusively used as your office. So it can't be a children's playroom, it can't be a spare bedroom, it must just be set up as a home office. That's the other big requirement.
You must have seen some interesting
Very
plans.
interesting. I can't believe, very interesting. I've seen, because then when we talk about the documents that you need to submit, you have to, as far as I've said, you need 360-degree photos. So they don't just want a picture of your workstation, they really want a picture from every corner of your room. So I've seen people with like moving out their bed, it's a spare bedroom, they move out their beds, there's children's equipment, you can see it like got a sheet over it, to try and make out that it's just used as an office. Quite entertaining. I love looking at those photographs of people's home office. So if you work from home more than 50% of the time, you've got your separate office, the cost that you can claim. If you rent your house, you can claim a portion of your rent. Then your utility bill, again, it's not your whole utility bill. SARS has also been quite strict in that regard. You can claim electricity, rates, taxes. If you've got a cleaner, you can claim a portion of your cleaning bill. You can claim wear and tear on office equipment, so computers, furniture, printers. You can claim wear and tear on that type of equipment. A big change in 2023, you used to be able to claim a portion of your finance charge if you were paying off your house and you had a mortgage bond. You can't claim that anymore. So that was actually quite a big change. And then SARS also were quite specific about the utility bill. Now, people used to submit their whole utility bill. They've specifically said you can't claim water, refuse, or the sewage element, because that's not specifically for your home office. Then also people get confused about telephone and data costs and internet. That actually, if you're a salaried employee, you can't claim that either. If you're a commission earner, the rules are different. Commission earners can claim those costs, but if you're straight salary, you can't.
Can claim it in full or percentage?
A percentage. So to work out all of this is percentage based, and it's all based on the square meterage of your home office in relation, showing the meterage. And then for the costs that you've claimed, you'd have to submit utility bills, basically proof of payments as well, not just the invoices. And then coming back to the photographs, the 360-degree photos.
It feels like a lot of stuff to check for SARS. It feels like there's a huge overhead on SARS to actually get through.
Well, I think that they were paying out so much with the home office deduction in 2020-21, so they've just got very much stricter. And what else? The letter from your employer you need as well. And that's about it. So there were a lot of people taking a chance and claiming from, people working from their dining room table, working from their couch, working from their bedroom, and all of that's been absolutely stamped out.
Right.
So if you do have a legitimate office and you do work from home, then you should be able to get the deduction. But for some people, it's not even worth the effort.
And that was I was about to say that, how much time and effort and therefore money really, especially if you're working for yourself, do you need to put into this? Is it worth getting that back? There was a question that came in via one of the forms, and we discussed this a little bit beforehand. And that question, I'll read it so that everybody can hear it. Is it true that if I claim for my home office space, that will have an effect when I sell my property?
Yes, it can do. It can do. So when you sell your property, there's a primary residence exclusion that applies. It's a 2 million rand exclusion, which means that if you make a gain on your sale, the first 2 million rand is exempt from capital gains tax. That's the CGT I'm talking about. The first 2 million rand is exempt. However, if you have used your house if you've used part of your house as a home office, that gain, that 2 million exclusion is actually reduced. It's prorated. Because it's not all your home, it's part used as a trade. And if it's used as a trade, then there will be capital gains tax payable. So there's quite a complicated calculation, and it all depends on the length of time you've owned your house, the length of time you've used your house for home office purposes, also the size of your home office, and then you do the pro rata calculation. But on TaxTim, I've written actually a whole blog on exactly that, and I've got a detailed calculation. So
Awesome. So everybody check out the TaxTim blog to understand exactly
capital gains tax
what the trade
and home office. Just Google that and TaxTim.
Okay.
You'll find the blog.
And again, that feels like like you were saying earlier that it's kind of a trade-off decision you have to make. Is like, if I use it as whatever I save, if I use it as a home office, if I save that in sort of tax back, how is that going to affect what I get out in terms of the sale of my house, or how much I'm going to have to pay later?
Yes, so it all depends exactly on the proceeds, the cost, the length of time. So you do a calculation and compare.
Right.
It might actually be quite negligible at the end of the day, and it might be better to claim the home office deduction.
Right.
The effect on CGT might be quite negligible.
Okay. So people should just read the blog and look at the calculation.
A lot of factors that go into it.
Okay. Cool. Okay, so medical costs. Most South Africans, at least probably most who are listening to this, would probably be paying to some sort of medical aid. How does it work, and what do people need to know around that? Yeah.
Okay, so if you contribute to a medical aid, you will get a fixed medical credit. A medical credit is it's a rebate, it's a deduction, it's a straight tax deduct, it's a fixed amount, and it's a deduction of your tax liability. It's a straight deduction of your tax bill. It's different to the other deductions we've been talking about. Home office, RA, that's a deduction of taxable income. People get quite confused between the two. But the medical rebate is just a fixed deduction of the tax bill that you have today. And also it's per dependent as well. So you'll get, as a main member, there's a fixed amount, 347 Rand, I think, as a main member, and your first dependent. And then if you've got additional dependents, it's a reduced amount. So the more dependents you have, the bigger the more medical aid rebates you'll get. Mm-hmm. But then in addition to that is and this is what confuses some people, in addition to that is the extra rebate you get for out-of-pocket expenses or qualifying medical expenses. And those are expenses that you've paid personally that have not been reimbursed by the medical aid. And so you need to keep track of all of those, but it's not all medical expenses. It's specifically prescription.
Right.
But it's also, you need to keep a list of all of those. When you submit those details to SARS, you mustn't just send off all your invoices and receipts, because you actually need to send them an Excel spreadsheet listing the date, the description, the service provider, the amounts, and then with all the backup. And it must be proof of payments. And also lately we're seeing them ask actually for the prescription as well. They want to see, this tax year we've seen that, they actually want to see the RX code on your prescription. I mean, most people don't necessarily keep that. So
I wouldn't even know where to find that. Is it on the bottle?
I mean, it's the first year we've seen that. Proof of payments is not actually enough. They're asking for the prescription as well. But then, very importantly, you actually have to, just because you pay extra for medical, you don't necessarily get more of a rebate. You have to pay, there's a complicated formula that SARS applies, and you have to actually pay quite a lot of additional medical expenses to get more of a rebate. Right. And it also, the formula is linked to your taxable income. So the more income, the higher your income, the more medical expenses you have to pay. So that's a common misconception. A lot of people say, but I paid all this extra medical, but I don't see any change in my tax liability. Well, the answer is you haven't paid enough to get the extra rebate. Yeah.
So as you're talking, what I'm thinking is, firstly, that sounds like a lot of effort across home office and medical to get these things back from SARS. Yeah. So firstly, a lot of effort, especially in the medical case. Secondly, I have to pay a lot of money. So I guess, like, how much is that? How much is a lot of money to see any effect?
Sorry, can I interrupt you? There was a bit of a glitch, and I just want to know if you could please repeat what are the qualifying medical expenses that can be claimed.
Oh, that's handy.
Okay, the qualifying medical expenses that can be claimed are prescription medicines. So over-the-counter medicines cannot be claimed. So Panado, Disprin, cough mixture, vitamins, that's not claimable.
Okay.
Only prescription doctor-prescribed medicines, and you have to actually show that. Lately we've been SARS is asking to see the prescription, the printout that you get from the pharmacist.
Right.
And then visits to doctors, registered medical practitioners. that's also claimed, that counts towards extra qualifying expenses.
GPs or specialists or both?
Yeah,
It can be
that's
anything.
all fine, yes.
So the question I was asking is like, how much do you actually have to spend? It feels like a lot then. I mean, these are like, this is designed for people who are quite sick.
It all depends on your level of income, of your level of taxable income, and also it's more if you're over 65, the calculation is a bit different, and you are more likely to get there's a lower threshold. Over 65 and people with a disability, then you are more likely to get an additional medical credit.
Right. Okay.
But it is still worth keeping track of. Okay. And also submit all. The other thing you should do is always submit, if you do belong to medical aid, always submit all your expenses to medical aid. Even if you know you've run out of your medical savings, submit it all, because when you get that medical tax certificate from your Discovery, there's an amount on there that will say these are amounts personally paid that were submitted and Discovery didn't pay out. That appears on your tax certificate. And then that automatically feeds into your tax return. So that actually saves you quite a bit of the pain of trying to list everything separately and submit. That's
a really good tip. Submit everything so Discovery effectively produces the document that tells SARS that you've paid in your personal capacity for these things.
Yes.
Okay. Pro tip. Like that. Good. Okay, cool. Any other questions coming through, Jan? No. Okay.
Not for the medical. What you covered now is fine.
Okay. Cool. Okay, so again, getting back to work, got a few questions around traveling for work and how that tax deduction works. When would someone qualify for a tax refund, I guess is the first thing, for traveling for work, and then how does it work?
Okay, so traveling for work, yes, we also get lots of questions about this. You can only claim for work, so this is for salaried employees. It's different if you're a sole prop and if you're a freelancer. For salaried employees, you can only claim for travel if you receive a travel allowance from your employee, which is specifically coded to 3701 and 3702. There's specific source codes on your payslip, and you receive a travel allowance, or you drive a company car, and that will also have its own fringe benefit SARS source code. Then you can claim for travel. And those would be people who travel for work, like sales people, commission, they drive around to clients. Then you need to make sure that you keep a logbook, very important. Keep a logbook, a detailed logbook, and you need to keep track of all your business trips, and also record opening odometer, closing odometer, the reason for the trip, the destination, the mileage. And actually record your personal mileage there as well. And at the end of the day, you fill in SARS will reconcile that logbook to what you filled in your tax return. So in your tax return, there'll be a travel section, and you fill in all your mileage details there, your business mileage, and then SARS will look at your logbook, and it all has to reconcile. Your logbook has to reconcile back to what you've submitted in your tax return. So, just to clarify the tax, and because we get a lot of questions about, sometimes people claim for travel, but they still have to pay in, and they don't understand why. Will they get a refund? How does that all work? Well, basically, your travel allowance on your tax return, your travel allowance is taxed 80%, generally 80% of your travel allowance will be taxed on your payslip each month. Because that's sort of the assumption that you travel, 80% of your travel is for personal reasons and 20% is for business. And then you submit your logbook, and if you've traveled more than 20% for business, you will get some tax back. If you've traveled less than 20% for business, then you will have to pay in. And if you don't submit that logbook, or if SARS rejects the logbook if it's not detailed enough, you will definitely have to pay in, because now you've only paid tax on 80% of your travel. And SARS will say, actually, well, what about the other 20%? So then you have to pay in.
So I'm just assuming that the freelancer or sole prop thing becomes a business expense then.
Yeah, it becomes a business expense. Yes, you don't just have that RP5, but you still need to submit a logbook.
Right. Okay.
Yeah.
So you still.
Yes.
The common theme running through all of this is evidence.
Absolutely. Yeah.
Okay. Cool. So we mentioned contractors, freelancers. Some people might have a job that they work pretty much full time, and then they do a bit of sort of stuff on the side.
Yes.
Yeah. So it's quite a nice sort of segue into this. How do people who maybe have a side hustle or potentially just work freelance or for themselves, how do they think about tax? Well, there's a couple of questions there, but yeah.
Okay. So if you freelance, well, first of all, you need to declare all your earnings to SARS. So if you have some freelance, ad hoc, additional income, in addition to a salary, that all gets, that you need to declare that to SARS. That gets added, so freelance income gets added to your salary, and the total will be taxed. There's no special freelance tax. People think that it's the same tax rates as your salary.
They add the two and then
Add
you
the two
pay
together.
the income tax rate. That
Exactly.
total
Yes, and
price
so often
is.
people say, why am I paying so much tax on my little bit of extra freelance income?
It's because it moves you up a tax
Exactly,
bracket.
exactly. Okay.
Yeah.
You're a bit more informed than a lot of people that ask us these questions. Exactly. So also important to know that if you freelance for an overseas company, you still need to declare that income. You convert if it's foreign exchange, you convert it to rands, you declare it. South Africans are taxed on their worldwide income. It's a residence-based system of tax, so you have to declare all your income to SARS. How can you reduce the tax on your freelance income? Well, it's very important to track all your expenses as well. All business expenses that you've incurred to earn that freelance income. For example, internet, telephone, perhaps you've employed some people, salaries to third parties. You keep track of all of those expenses, and that will reduce your freelance income. And you declare that, pay that over to SARS. But importantly, if you're a freelancer, you are a provisional taxpayer.
Right.
Which
So let's just talk about the difference, seeing as we're there, between provisional taxpayer and PAYE, just so people understand that difference. Yeah.
Okay. So salaried employees, they get tax deducted every month. That's employees' tax, PAYE. You'll see it on your payslip. Every month you're paying tax over to SARS. But however, if you're a freelancer, you do not pay any tax. You're just earning your income. You're not paying tax over to SARS. And therefore, that's why the provisional tax system exists. It's not a separate form of tax. It's just a payment mechanism to pay tax to SARS during the year that you're earning the income.
Right. So if you are a salaried employee, but you also freelance on the side, do you then have to register as a provisional tax payer?
Yes, you do. Yes, you do. So if you freelance, you have to, if you're salaried and you freelance, you have to register as a provisional taxpayer.
So you will make use of two payment methods to SARS throughout the year. You will make use of PAYE.
Yes.
And that will be deducted from your paycheck.
Yes.
You will also have to register as a provisional taxpayer to declare that other income.
Exactly.
SARS accordingly.
Yes.
Okay.
Yes.
Good to know. One of the questions that came through was around a double tax treaty. And how do I get refunded by SARS or tax exemption from SARS because of paying tax in another country? And we were talking about residency laws and times and that kind of thing. I guess that's what this question is asking.
So so this can all get quite complicated. It depends. So if you are working on an expat contract overseas, and many South Africans are, but they're still remaining tax resident in South Africa, then you can claim what's called the foreign employment exemption, where the first 1.25 million is exempt from tax. But you have to fulfill this 183 days, 60-day test. You have to be outside of the country for 183 days with 60 days continuous, and then you can claim
per year.
Yes, per year. Well, for a 12-month in a 12-month period.
Right.
Then you can claim this 1.25 million first is exempt. You also declare if you pay tax in the foreign country, then you would also declare that tax as well in your tax return, and SARS you'd get a rebate for that. If you've broken tax residency and you are now not ever returning to South Africa and you are no longer resident, then you don't have to declare you don't have to declare your foreign earnings anymore. It can all get quite complicated. If there's a double tax treaty agreement, you need to look into that as well, and that might exempt you from paying tax completely in South Africa. So each scenario needs to look at really where is the taxpayer resident? Is it South Africa still? And it can get quite grey and difficult to work out. Have they broken tax residency or not? And then depending on whether they're non-resident, resident, or a DTA applies, they'd be taxed accordingly.
So just to be 100% clear, if you live in South Africa and you are working for a company that is based overseas, you are a tax resident in South Africa.
Yes, that's right.
That's right. You'd have to declare that income. I think a lot of companies that are based elsewhere pay their South African workers as a contract worker for whatever reason. So
Yes.
they're getting that money in, but it's not going through the PAYE system. So
Yes.
provisional taxpayer,
You're
declare
provisional
the income,
taxpayer.
declare
Exactly.
the income. Yeah. Okay.
Yeah, then you're provisional taxpayer, declare the income. So it's always good to keep some money aside, and it's a way of paying tax over during the year to SARS. Twice a year, you pay it in August, 6 months into the year, and February. So you need to, and it's an estimate. You have to estimate your earnings for the year. Provisional tax is, people get quite confused about it. You have to estimate your income and expenses during the year, and then pay over half the tax in August, 6 months into the year, and then you estimate it again at the end of the year, and you're paying over. It's based on an estimate, but then you still need to file an individual tax return. So provisional taxpayers actually need to file 3 returns a year. They file the 2 RP6s, those 2 provisional returns, and then they also submit the annual tax return after the year ends. So the annual tax return that's where you declare your actual income and expenses, and and then there's sort of a reconciliation of your actual, and then you look at your provisional tax payments you've made during the year, and then there'll be an under or an over that you claim back from SARS or have to pay to SARS.
Right. So it's three tax returns, and if you've got the estimation wrong, you're either going to be paying in when you do that individual tax return, or they're gonna give you a rebate. So effectively going to pay you money if you've estimated incorrectly.
But you need to make sure you don't get it too wrong, because there's some penalties involved if you've underestimated.
Oh, really?
Yes, there's what's called an underestimation penalty. So if you, and it's also if you have to get within a certain percentage of your actual taxable income, and if you within 90% of your actual taxable income, if you earn under R1 million, and if you earn over R1 million taxable income, you have to get within 80% of that. And if you breach those thresholds, then SARS will slap on an underestimation penalty, which is actually can be quite hefty. So you can't, because people could underestimate, they don't want to pay the tax over, they underestimate.
Sure.
They don't have the cash right now. So you need to, one needs to be quite careful about that.
Just talking about penalties generally, just sort of diverging from the script, like you must see a lot of questions around that. And is this a legitimate penalty, and why am I paying this? What are the most common sort of queries or around penalties that you get, and what are the most common penalties people pay in this country?
There are lots of them. So provisional tax. So if you pay your tax, so the provisional tax deadlines are the one coming up now is the 28th of Feb. It's always going to be the last day of Feb. If it falls on a weekend, then it's the public holiday, then it's the day earlier. And August, the last day of August. So August is the first one, and then Feb is the end of year one. If you pay even a day late, there'll be a 10% late payment penalty for provisional tax. So that potentially can be quite big.
10% of what?
Of the tax that you pay.
Money that you're paying.
Yes.
Wow. Okay.
So that can be very big. So you mustn't be late with your provisional tax. There's the late payment penalty, and then the other one is the of your filing of your tax return. It's called the administrative penalty. If you file your tax return late, SARS will also slap on a penalty if you miss the deadline.
And that deadline is, just to be clear.
Yes, the deadline is there are 2 days. So the deadline it's always in October. So for salary, there are 2 different deadlines. So if you're a salaried employee and you're not a provisional taxpayer, the deadline it's around about the 23rd of October, 21st of October. It changes at some time in October.
Okay, good.
And for a provisional taxpayer, it's January the following year.
Okay.
And if you miss that deadline, you get an admin penalty per month until that tax return is filed. And that admin penalty it also depends on your taxable income, and it can range from like $250 a month to 16,000 Rand a month. But you need to, be very careful about making sure you file within the right deadline. We get a lot of people who think they're provisional taxpayers, and
why would they think that? Just
because they say they earn investment income or rental income, but there's some thresholds. I'm not sure I don't think we've touched on it yet. There's a threshold. You have to earn more than 30,000 Rand taxable in rental income or taxable investment interest. If you earn below that amount, you're not a provisional taxpayer. So people think that, and this could change every year. One year you may earn above that, and then you are provisional, but the next year you may earn below that, and you're not provisional.
right.
So you might think you're provisional because you earn taxable interest, but your taxable interest is maybe only 15,000, and you think, okay, well, interest, I've been provisional, been that before, so I'll file in time for the January deadline, and then SARS will say, actually, no, you're not provisional because you don't qualify because you're below the threshold and you should have filed in October, and then you will get a penalty November, December. Yeah.
Okay.
So you need to be very aware of the deadlines and are you provisional taxpayer or not, and which deadline applies to you.
Okay. I thought we were going to bring clarity to this. It feels like it's getting more confusing. But basically what you're saying is, understand, are you or are you not a provisional taxpayer, especially if you're earning income from a place that isn't your salaried role or your actual business
Yes.
as a freelancer.
Yes.
Like those thresholds, it's important to know that. That I didn't know. So that's
Okay.
easy to do. Yeah.
Okay, so just to clarify, freelancers are always provisional taxpayers. It doesn't matter how much extra or how little, there is no threshold. If you're freelance, if you earn any additional ad hoc income, you are a provisional taxpayer and you must file provisional returns, and the later deadline applies to you. If you earn interest and dividends, rental, you may be, but you need to check the 30,000 is the limit, and that's taxable rental and interest. Because remember, there's an interest exemption which applies, so it's 30,000 taxable interest. Above that, tax-free 23,800.
Okay. So what is it? So if I earn 29,000 Rand rental income and I'm a salary, I'm on pay.
29, yes.
Yeah, and I earn 29,000 a month extra. What happens to that? How is that money taxed?
Okay, it's 29,000. If that's your net taxable rental, it's below the threshold. You're not provisional, and you don't have to file provisional returns, and you include that rental income in your tax return.
Right.
You just include same with investment income. If you earn below that threshold, you just include those details in your tax return, and you'll pay tax on that interest and on that rental when you file your tax return on assessment.
You have to have money aside to pay that when SARS asks for that money. Right?
Yes.
So it's also a case of, even though you're not a provisional taxpayer, have some cash to pay that tax.
Exactly. Well,
Right.
you might have to pay in some more, unless you contribute to an RA, in which case. Yeah.
Does SARS do that calculation? Where they're like, oh, you were paying to your RA. Or
Well, that's what happens in your tax return.
Right.
So in your tax return, you'll include your details of your RA, some medical, some donations, which might offset.
What you would have paid on the 29,000 rental income.
You can declare all of that. That's what goes in your tax return.
Okay.
And at the end of the day, on assessment, there'll be the excess you owe or the amount that's refunded to you.
It's kind of like debit and credit. It's like, here's what I paid that
Yes.
you will give me a rebate on, and here's what I've earned.
Yes.
And what you need to tax me on.
Exactly.
Okay.
Yes.
Just confused with the accounting metaphor. Shit, Carl. Let Nicci talk. Okay, so we've talked about provisional tax. Was there anything else you wanted to mention around that?
I don't think so.
Because the next point is the investment income, which was potentially you're a provisional taxpayer, but
Yes, but with investment income, you just need to know the threshold. That there's this 30,000 Rand limit. It's rental and investment combined.
okay.
If you earn less than that, you're not a provisional taxpayer. Just include details in your tax return. If you earn more than that, you are a provisional taxpayer. And then you submit your 2 provisional returns a year, pay the tax to SARS during the year based on your estimated earnings, and then also file a tax return after the year end.
Okay, good. Hopefully people are clear on that. One type of investment that's been generating a lot of headlines, I think you have to be living under a rock if you haven't heard of
Yes.
Bitcoin and cryptocurrency, but there was a lot of opacity with SARS around how those investments, were they, to be taxed as investments, were they to be taxed as, whatever. How does SARS see cryptocurrency or earnings generated from what is effectively speculation, but let's call it investment in cryptocurrency?
Yes. Okay. So there's definitely been a lot of attention to this lately. So crypto transactions are taxed according to existing South African tax law. There's no special tax laws applicable to crypto. And important to know also that SARS regards crypto as an intangible asset. So if you think about it that way, so therefore any disposal of cryptocurrency is a taxable event.
Okay.
And it can only be taxed in 2 ways. It will either be taxed as a revenue type of transaction. The gain will then be added to your salary and taxed at using the exact same tax rates as your salary. And that's really for people who are trading in crypto.
Right.
And I'll go a bit more into that in a bit. Or it can be taxed, or the gain can be taxed as a capital gain if the crypto is regarded as an investment. You bought crypto for investment purposes. And then there's the capital gains tax rules apply, which is more beneficial tax rates because only 40% of the gain is added to your taxable income, and there's a 40,000 Rand annual exclusion. So there the tax will be lower if you're calling your crypto an investment, or you bought it for investment purposes.
Right. So do you get to delineate what's for investment purposes versus what's trading, or?
So that's really for the taxpayer who's filling in their tax return to disclose their intention behind the crypto, and also they will have to submit documents and proof. So it is quite easy for SARS to see really what was the intention behind this crypto activity. Is there a lot of activity, buying, selling within a short period of time? That very much points to the fact that this is most likely trading, in which case it has to be reported in the local business section of the tax return, and it's a trading activity, and it's just taxes. The gain is taxed as normal income. Or have you bought crypto and held onto it for like 3 years and then sold it? In which case, that very much implies that it's an investment, and the capital gains tax rates will apply. So it's really up to the taxpayer to declare that way, and then SARS can ask for supporting documents.
Right.
And then you need to give your then it becomes very tricky, because a lot of people don't have all the documents, and it becomes quite confusing and difficult to work out. But it's quite easy for SARS to see if there's a lot of buying and selling. You have to explain to SARS how you calculated the gain. So you can, and when was the sale, when was the purchase, when was the sale, what's the time frame. So it's quite easy to see if it was for an investment or if it's regular buying and selling.
Okay.
But it is difficult to work out the gain, and there's a lot of confusion around how you report all of this to SARS. But there are some handy apps, I think, that have been developed, which help with tracking of the cost and the working out of the gain, and you can use that for when you do your tax return.
Okay, so what have you seen most regularly at TaxTim around crypto? Is it just confusion about how to report it?
Yeah.
Or is it actually the actual number crunching?
The number crunching, how to calculate the gain. So a lot of people are buying and selling. And then the exchange rates involved, and SARS have said they said that you need to use the FIFO method of accounting. So that's first in, first out. So if you sell your crypto, then the first crypto, the crypto that you bought originally is the crypto that you've sold at that price. So you apply the FIFO, but you need to keep track of the cost of the crypto that you're selling and the exchange rates. And it's complicated because also there's crypto being exchanged for other types of cryptocurrency. And that's actually also regarded important to know as a taxable event.
Really? So you're buying Ethereum with Bitcoin,
yes,
another type of cryptocurrency, right?
Yes.
That's also taxable.
That is taxable, yes. And it becomes tricky to work out the gain, but that is taxable, yes. Because you are still effectively selling an intangible asset, even though you're trading it for another asset. It's like a barter transaction. The Tax Act basically states, you're selling, if you sell something for cash or otherwise, it will give rise to a taxable event. So that's the otherwise.
That's the idea. You're getting something.
You're getting something, and which is probably of a higher value.
Yes.
So there's tax on that gain.
Interesting.
But it's tricky to, it is. There's Coinly is one of the apps that people are using.
Okay.
There are a couple of crypto tracking softwares that people are using to track the.
Coinly. Okay.
One of them, yeah.
Good. Excellent. Anything else you want to mention for South Africans around being savvier taxpayers, or for their own understanding?
Okay. I think really I think we've really spoken a lot about it, just to keep on top of your admin. I mean, everybody hates admin, but it's the record keeping, tracking all your expenses, keeping all your invoices and proof of payments, and even your prescriptions. Because if you don't report that to SARS, you don't actually, and you aren't eligible for a tax deduction, then you will effectively end up paying more tax. So it's really to keep on, especially also if you're a freelancer, to keep on top of your record keeping, keep all your documents. If you're a freelancer, it might be worth opening up a separate bank account for your freelance activities. It might make it easier to track your expenses and your income. If you travel, just make sure you keep that logbook. keep your paper documents. It might be best to.
I was going to ask, so digital documents versus something that you've been given an invoice, is the onus on me now to scan everything and to put it in a folder for SARS?
Yeah, it might be better to do it that way because the ink fades on the documents, so it's probably better to just photograph and keep it somewhere on your computer, somewhere handy.
Right. But don't lose the original, whatever you do, because SARS can ask.
They don't really ask for the original,
okay.
no, you pretty much always scan the documents in.
Okay. So as long as you've got something.
Yes,
on
the digital is normally fine.
Okay.
Yeah, just keep on top of the deadlines, very important. Make sure you don't miss the deadlines, make sure you know if you're a provisional taxpayer or not.
Okay.
Familiarize yourself with all the penalties, the underestimation penalty, be aware of that as well if you are a provisional taxpayer. Yeah.
Okay. So we had some viewer, I hope they're still viewing after we've been chatting away, questions that came through. The first was, we obviously specialize in retirement investment products. So a lot of the type of tax questions that we see are from retirees and our clients who have living annuities with us or other products. How can they limit taxable income when retired?
Okay. That's tricky. If they earn taxable income, they will be tax payable. Make sure that if there are any expenses that they're eligible for, that they always include them, like medical costs, medical expenses. Be aware of if you donate to any charities, make sure that you include those. They are more favorable, there's a over 65 and over 75, there's a secondary and a tertiary rebate. So the tax the tax rates are a bit lower over 65, and also they're more beneficial for medical. The medical credit is also more beneficial if you're over 65. So yeah, definitely medical is another one. Just keep all your expenses. But if you're earning a pension, unfortunately it is all subject to tax, but there are more favorable rates.
Okay. And then a couple of questions around small business and small business taxation. So effectively, I guess I'll just read the question that came through, but I have a small electrical business that's 2 years old and I want to find out the best ways to pay tax. 27% sounds like a lot of tax to pay on any profit that I earn. And the second kind of question which tags onto that was, what happens from a tax point of view if a business expense or business expenses are more than earnings? So in the case of someone who is earning some sort of profit from the business, and then secondly, if they're making a loss, what happens and how this starts?
So just in terms of reducing your tax payable, the only way really to reduce your tax payable is to reduce the taxable income. So it's your expenses. You need to make sure that you report all your expenses, all business expenses that you attributable to earning that income that you've incurred to generate that income. Just need to keep track of all of them and keep all the documents, and that really is the only way to reduce the taxable income and ultimately the tax that's payable.
Okay, and if expenses are greater than earnings in the first year.
Okay, then also yes, so you must report all of those expenses, and there'll be a loss in that year. And this loss will just be carried forward into the next year, and so it's important to keep track of all of them and record them in your tax return. And then when in the years that you do generate a profit, that loss will be offset against the profit in future years. So it will reduce the tax payable in the future years.
Okay.
Yeah.
And then how can I maximize tax deductions for rental properties that I own? I think we might have touched on this previously.
Tax deductions for rental properties.
Be aware of your expenses and what.
Yeah, be aware of the expenses. Yeah.
You were mentioning some.
Water, electricity, cleaning, and that's different to home office. So there you can claim if you've got a bond, you can claim your interest on your bond, your utility bills, estate agent fees, all costs that you've incurred.
Okay. Just be aware of what you actually can claim, because you were saying, wear and tear on furniture.
Yes, wear and tear, repairs and maintenance.
Yeah.
All of that's claimable.
Okay. Cool. So we're going to throw it open to the floor and see what's come through on the live stream. Dev Casey asks, do I need to pay tax if I'm a freelancer and my earnings fluctuate? I guess the blanket answer there would be yes, of course you need to pay tax, but
Yes.
if your earnings fluctuate, then you're potentially moving up and down through different tax
So
brackets.
yeah, it's a tricky one. So but also just be aware of the threshold. There's a tax-free threshold which I haven't actually mentioned. Of it's around 95,750, I think. If you earn under that amount for a year, there is no tax payable. If you earn over that amount, yeah, you do need to pay tax. If your earnings fluctuate, it's tricky. If you're a freelancer, you fall into the provisional tax system. You have to make some kind of an estimate during the year. And pay tax midway into the year and into the end of the year.
Okay. And then you've got those 3 deadlines that we were talking about.
Yeah.
Don't be late.
Yeah, exactly.
Okay.
Yeah.
Cool. All right. Question from Bruce. Can a provisional taxpayer start working on the e-filing system early during February to be able to determine the amount of the RA that is payable to balance out or reduce the amount of tax payable? It's a bit of a mouthful.
Can work on the e-filing system to work on.
Early to determine the amount of, I assume, RA rebate or
Okay,
RA is
okay.
payable back to them.
So when you do your provisional tax return, the provisional tax return is quite a simple thing on e-filing. You just have to enter your estimated taxable income for the year. So you need to just factor in your RA contribution in there. So if you've contributed to an RA or you plan to, reduce your taxable income by that amount of the RA, and then the tax calculated in that return will be adjusted for the RA. It will be a bit less. So yes, you should factor in the RA. If you plan on contributing to an RA, you can pay less provisional tax.
Okay. I guess another way to look at that would be you have that 350,000 limit. Whatever you've contributed to the RA, just take your nominal tax rate, and then if it's 35%, take 35% of that contribution, and that's roughly what you'll be getting back from SARS.
Pretty much. Yeah.
So if you contributed 100,000 to your RA, you're going to see 35 of that back. Right?
Yes, basically, yeah.
So just like a sort of back of the envelope calculation.
Yes.
But yes, you can go on and do that calculation, factor in your RA as your taxable income. That's what you're saying.
Yes, that's right. I think he's saying, can you reduce your provisional tax if you're contributing to the RA? Do you maybe not need to wait for it to come back when you do your tax return? And the answer is yes. If if you're going to contribute to the RA, yes, then pay less tax. There's no point in overpaying provisional tax when you know you're going to be contributing to an RA and reducing your taxable income.
Got you. Question from Eric. What about VAT if you are a freelancer earning more than R1 million?
Yes, then you need to register for VAT and add VAT to all of your invoices.
Okay.
And charge VAT to your clients and file a VAT return.
Just pass the cost on.
But then of course you can also claim VAT back on all your expenses.
Okay.
But yes, if you're earning over R1 million in a 12-month period, then you need to register as a VAT vendor.
Okay, good to know. If you have capital loss from the sale of shares, does this need to reflect on the provisional return during February? It's from Bruce again. As I understand that, it will only be offset against previous losses.
Yes, so capital loss can't set it off against income, so it's not going to reduce your provisional tax that you owe. Okay. You report your capital loss in your tax return, and it will reduce future gains.
Cool. And that is 2 minutes before 1. We've flown through pretty much everything I guess people ask you in TaxTim on the tax system. Thank you so much for being here. To everyone who is watching, or is still hanging around, thank you so much for joining us. If you have other questions or you want to get in touch, please get hold of TaxTim.
Yes.
TaxTim.com. Pretty simple.
That's right.
And again, thank you for joining us. We'll be sending out a copy of the recording to everybody. And hope to see you again.